This is the fourth in a series of videos describing how to work with the Excel financial projection template provided by Prosper Women Entrepreneurs Accelerator. A copy of the Excel file can be obtained from Prosper at prosperstl.com. This video addresses using the template for constructing a financing plan. Once estimates of revenue and cash flow are complete, the amount of money needed to finance the business becomes clear from the cumulative operating deficits. The next question is where it comes from. Prosper's Excel template assists with financing by identifying the need for cash, simply modeling alternatives for amounts and timing of financing raised in successive rounds, building in the basic terms of standard early-stage financing securities, and providing alternative methods for estimating the valuation of the company in each round as well as the exit. The Prosper template also calculates pro forma capitalization tables in each round and investor returns as measured by IRR and cash-on-cash multiples. Let's look at the first and second issues, which are the cash need and the amount and timing of financing rounds. The hypothetical company in the template, by default, has estimated cash flows using the model's operating input, and it projects the company will run operating deficits cumulatively amounting to about 1.7 million. Using the template, the company has specified 3 financing rounds using common financing instruments to cover the 1.7 million. These rounds are shown as red tent poles in the right-hand graph. In this case, Corey Sass raises 3 rounds of $250,000, $500,000, and $1 million for a total of $1.75 million in the first, third, and 10th month of its first year to provide the required financing. Note that the company raises $150,000 more than its minimum requirement. Because of the timing of cash flows, Corey Sass has a minimum cash cushion of only $8,000 at its time of greatest need, which is very tight. Founders will have to figure out how much cushion they feel they need and adjust the amount they raise and the timing of those raises to hit whatever their comfort level is on the cushion. Will have to recognize that more cushion will require them to give up a larger ownership in the business. Prosper's template assists with a third issue, which is modeling standard early-stage investment securities. Most early-stage investment falls into one of 3 basic types of security. Convertible notes are the commonest in very early-stage ventures, and they carry an obligation to repay both principal and interest before any money can be paid out. Principal and interest on the notes usually don't pay cash, but convert instead into the security of the next round, and usually at some discount, such as, say, 20 to 30% to the price of the next round. This means convertible notes actually defer determination of the value of the company until a subsequent round, when presumably a larger number of investors, more sophisticated perhaps, will set the valuation. It's worth noting that a relatively new instrument called a SAFE, or Simple Agreement for Future Equity, is a variation on a convertible note that doesn't typically accrue interest and which is simpler and cheaper to document. Think of a SAFE as a simple convertible note. A second common early-stage investment instrument is convertible preferred stock, which retains a priority in either liquidation or exit, and which is convertible at the option of the investor into an agreed-upon share of the business, requiring a valuation of the business. A sample valuation might be expressed as, for example, a $5 million investment that buys 25% of the company, in which case the implied post-money value of the business is $20 million. Convertible preferred almost always comes with specific investor rights, which are a separate topic for another day. Some rights are purely economic, such as the share of the company that investors own and dilution protection, if any, and some rights are governance rights, which, for example, protect the new minority owners by limiting the company's ability to sell, raise financing, or take other actions without either unanimous or supermajority shareholder approval, say, for example, 80%, where convertible preferred votes as if its shares were equity shares. A third form of financing instrument is participating preferred stock, which is a variation on straight convertible preferred stock. The principal difference is a persistent priority in repayment, usually expressed as a multiple of the original investment amount. So participating preferred with a 1.5 times preference says that the company must pay back 1.5 times the original amount of the investment, plus provide investors with a share of the business before any equity shares can be paid in a liquidation or exit. Participating preferred preferences usually escalate in future rounds, so be careful about agreeing to preferences because they rarely decline in future financings. Prosper's template also facilitates valuing of the company in each round and at exit. Most financial valuations usually start with comparables analysis, which is the most common negotiating frame for valuation. This type of analysis identifies comparable companies, calculates their valuation metrics, usually enterprise value to sales, enterprise value to EBIT, and you have enterprise value to EBITDA, and then applies those valuation metrics to the startup being financed. You can aid and perhaps influence the process of identifying customers that you think are like yours, which means that they serve your target customer with a similar product or service and a similar business model. Investors are interested in comparables in three categories: venture-backed companies, acquired companies, and publicly traded companies. A key limitation of this approach is that financial metrics are rarely available for any private companies, venture-backed, acquired, or otherwise. And another drawback is that although public companies report all desired financial metrics, they're usually significantly larger than early-stage businesses, and comparability can be hard to establish. Once comparable metrics have been established, the exit multiple valuation can be roughly estimated based on projected sales or EBITDA. This is the principal input for the venture capital valuation method, which takes that exit value and discounts it back to a value for each estimated round. So the venture capital valuation method is fundamentally a discounted cash flow or DCF method, and it simply takes the projected exit value and discounts it back at some rate. Now, the amount of that discount is a subject of significant debate. The last slide simply says that financial theory can describe but not really determine how valuations are set, which are appropriately the subject of negotiations based on demand and supply for early stage investment capital. Financial theory generally accepts that an investment in an early stage company deserves to earn somewhere between 2 and 10 times the original investment, or 15 to 60% compounded annually over 5 years, to compensate for the extraordinary risk that startup companies face. The difference between 15 and 60% required returns illustrates the gap between various possibilities and the room for negotiation. Venture financing is not an efficient market in the capital market theory sense. And if you want to raise money, our best advice is first to have a great business, second to be able to tell your story well, third, identify as many early stage investors in your segment as possible, and finally, raise more investment capital than you think you'll need in order to put yourself in a position to negotiate good terms. Okay, with all that behind us, let's turn to the Prosper template. At the bottom of the Assumptions tab, you may recall that the prior video left off discussing balance sheet and cash flow assumptions. At the bottom, you'll find a set of finance assumptions, which is the last major segment of the assumptions page and of the model. You can see here that the finance assumptions begin by showing you what the sum of operating cash deficits that you need to finance is. It calculates that number. It's not an input number because it's not in red. And it gives you some guidance about what kind of money you need to raise. A second section deals with exit calculations, and it gives you two methods for your exit, for valuing your company at exit: multiple of sales or multiple of EBITDA. In this case, we've chosen multiple of EBITDA, and we're specifying a 10 times EBITDA exit multiple in 60 months, which means 5 years. And we're saying that the company needs to retain $1 million on its balance sheet. Anything over that amount, it can dividend it out to shareholders at the time that it exits. The next section deals with the specifics of the kind of note or financing instrument that you use for your early stage financing. You can choose a pre-existing form of financing prior to the forecast period, or early stage, Series A, Series B, or Series C. In this case, we've chosen an early stage and a Series A and a Series B. There is no Series C, but we have the provision for it if we wanted it. The type of security can be specified any one of the three we discussed. In this case, the first is a convertible note. It converts into a participating preferred, and there is yet another participating preferred round later on. The timing is that the first convertible note, the only convertible note, is raised in the first month of the forecast period. The participating preferred is raised in the fourth, and the Series B is raised in the 10th month of the forecast period. The amounts are $250,000, $500,000, and $1 million. Also, as part of the terms of each financing round, the investors typically require an increase in the size of the option pool, to a certain percentage or buy a certain percentage of the company. In this case, the investors are requiring the option pool increase to 10% of the company at each of the 3 rounds. If the security is a convertible note, fill out this section. In this case, we have one convertible note, and we're saying it has an 8% annual coupon, a 30% conversion into the price per share in the next round, and the round that it converts into is the Series A round, could be the B or the C, or even early stage. If the security is a participating preferred, which it is not in this amount, so we can simply delete that number if we wanted to, or leave it. You specify the preferred return. In this case, the Series A participating preferred gets a 1.0 preference. The Series B gets a 1.5 preference. Series C might also get a 1.5 or 2, but there is no Series C. We can delete that or leave it and let the model ignore it. There are several methods for estimating the valuation of the business in the price rounds, which in this case are the Series A and Series B. The model gives you 4 methods. One is the annual multiple of the 3-month average MRR, which is a common SaaS model. In this case, the MRR is so low in the early months that that's not the way we want to value the model. A second method is to simply input the number, the valuation of the business in each round, which you can do. There's no theory involved in that. You can use the venture capital valuation method that's built into the model, or you can use a variation of it, which is to start with the valuation method and pick a percentage of that. In this case, that's what we're going to do. We're going to let the model calculate what the venture capital valuation model would value in a given round, and then we're going to say that the valuation for us is 80% of that theoretical value. If you wanted to enter the multiple of MRR method, you'd enter the number here. It's irrelevant. You can leave it alone or delete it. And if you use any kind of venture capital valuation method or discount method, which we are using here, the model will ask you for the discount rate. It's irrelevant in the first stage because there is no valuation for a convertible note. The valuation only becomes relevant for the Series A, Series B. Of course, there is no Series C. We can delete that as well. And we pick 75 and 60 actually fairly randomly, but recognize again that the valuation we're going to get is not a 75% IRR discounted value. It's going to be 80% of a 75% discounted IRR value. If you're inputting the numbers, you would input them here. We have not picked that method, so we can ignore or erase those numbers. The only 2 inputs remaining are the number of the shares in the option pool at the beginning of the forecast period. You want to know how big that option pool is, and you want to know how many common shares are outstanding. With those, the model can make the projections for you, and you'll find them in the monthly projections section. This goes out to the 60th month. Here are the numbers for the earlier months. You can see it calculate. Here is your early stage valuation. It's not a preferred round, but it does issue option shares. Series A valuation round is here. Series B is here. And it calculates a number of things, including what the post-money value is, what the new investor ownership is, new shares issued, and so forth. There are a number of graphs which can model what's going on. Here's the monthly cash flow graph, which you saw earlier in this presentation, right beside the break-even, the income statement break-even graph, if you're into that. There are a number of other graphs too. I will point out, excuse me, not graphs, but charts. And I will point out the annual summary, which will, if you have an off month, if you have a strange annual month, or if you're starting your forecast in something other than your fiscal year, it'll calculate what those numbers are. There's a financing summary which shows the statistics and returns. Here you can see, because we chose the 80% of venture capital valuation method, it got slightly better than 75% IRR, 16 times the investment, and it calculates the values for you. Cap tables are shown as well. Again, no cap table particularly relevant for the first round, which is a convertible note. You just want to know what the convertible note is. Then there's a Series A and a Series B. And you can see the percentage of the companies given up in each. That pretty much does it. With this, you have the fundamentals of putting together your financial projection. Thanks for paying attention. If you have comments, please leave them for us on YouTube. We will pay attention to that stuff, or even better yet, email us at prosperstl.com and let us know what you like and don't like about the model that we put together. Thanks a lot.